Welcome, my name is Elizabeth Moran and I'm presenting this Expanding Your Bond Knowledge webinar. First, a little bit about me. I'm a nationally recognised fixed income expert and have been passionate about educating investors for many years. I am currently Editorial Director at Fixed Income News Australia and Income Strategist at Intelligent Investor. I've also had a regular column in the Australian newspaper for 7 years and been quoted in or appeared on all the major media outlets. I've presented at many educational sessions at investment conferences across Australia to high net worth individuals and financial advisors, and I've even written 2 books on the fixed income asset class. So I'm very pleased to be given this opportunity to partner with Income Asset Management to present these educational webinars. This is the Expanding Your Bond Knowledge webinar, which offers general information only. The webinar is entirely educational. There are no products or recommendations. Please do your own research before you invest and read the Financial Services Guide and Product Disclosure Statement before making any decisions. First, the agenda. Market expectations and ways to help you interpret its direction. Interest rate risk and duration. An extreme duration example. Yield and spread. Credit ratings. Asset-backed securities and building a bond portfolio. Market expectations. If you are thinking about investing in fixed income, interest rate expectations will help you shape the types of fixed income securities that you choose. It's a good idea to read widely and understand the market's expectation for interest rates and also form your own view, which may be different to market expectations. If the general direction for interest rates is up, you might prefer floating rate securities where income will rise if interest rates rise. Or if the general direction for interest rates is down, then you might prefer fixed rate bonds that lock in income for the life of the bond. I would suggest you identify economists and market commentators to follow that you have an affinity with. Here are some of the common indicators that will help you form a view. Here is a graph of the US 10-year government bond yield over the last 10 years. US government bonds are a global interest rate benchmark, as they're considered zero risk. That is, if you hold the bond to maturity, you're assured of getting your capital back. Current yields are just over 4% for 10-year bonds. So if you're investing in a corporate bond over the same term, you need to make sure that it's paying you enough for the additional risk you are taking over and above that zero risk benchmark. The graph also shows that interest rates have hovered around 4% for the last 18 months. You can see that it's ranged from a low of under 1% during tough economic conditions about the time of the global COVID pandemic. Central banks had cut interest rates to try and stimulate economies, but when many businesses had closed and were finding it hard to survive. In late 2023, when the low interest rate environment had stimulated the economy and the US was growing fast and inflation was high, the US Fed had been increasing those rates to try and get it to slow down. The US 10-year government bond yield reached a high of close to 5%. Equally, the Australian 10-year government bond yield is also worth keeping track of. First thing you would notice is that its path over the last 10 years is different but not dissimilar to the 10-year US government bond yield. As of the same date, the Australian 10-year was about 20 basis points or 0.2% higher than the US 10-year government bond yield. Again, the rate has hovered around the 4% mark for the last 18 months. The cash rate and the bank bill swap rate are 2 must-watch figures when considering the direction of interest rates. The Reserve Bank Board sets the cash rate in Australia and they meet 8 times a year. Then they also share their thinking in the minutes as to how they came to their joint decision. Now, the RBA Board is independent and is charged with deriving the best outcomes for, first, the stability of the currency of Australia, second, the maintenance of full employment in Australia, and third, the economic prosperity and welfare of the people of Australia. The 3-month bank bill swap rate, or the 90-day bank bill rate, is calculated on every business day and is the rate where banks are largely indifferent between fixed and floating interest rates. You'll see on the graph that the cash rate and the 3-month bank bill swap rate closely track each other. They're shown in the red and the black lines. The graph also shows the real cash rate, which is after taking inflation into account. The Bloomberg Oz Bond Credit 0+ Year Index will help you evaluate the performance of Australian corporate bond market. It shows the average credit spread of the most liquid investment-grade corporate bond issues in Australia. This graph shows the reading as 70.54 basis points. Remember, 100 basis points equals 1%. The wider the spread, the higher the perceived risk and the higher the reward. High yields can be an indicator of an attractive market and at times are considered cheap. When margins are low, the market is less attractive and can be labelled as expensive. To be included in the index, bonds must have a minimum amount outstanding of $100 million, and there are maximum weightings of 4% per issuer. The index includes fixed, floating and inflation-linked bonds and is rebalanced monthly. Interest rate risk and duration. Fixed rate and inflation-linked bonds take interest rate risk. The coupon on a fixed rate bond does not change over the life of the bond, and an inflation-linked bond pays a fixed rate above inflation, so it can also take interest rate risk. Now, interest rate risk can be positive and it can also be negative. Think about taking out a mortgage to buy a house. You can choose to fix a rate of interest that you will pay on that mortgage. You lock in known interest payments for a set term. You'll benefit if interest rates move higher than the rate you're paying, but if they fall, you're locked in to those higher mortgage repayments. There's a definite benefit in taking interest rate risk at different times in the economic cycle. Fixed rate bonds become more attractive when interest rates start to fall. Investors want to lock in higher returns, so are prepared to pay more for bonds than their face value. The only way for fixed rate bonds to reflect changes in interest rate expectations is through the bond price. So bond prices can move higher and provide an additional reward if you decide to sell. A bond's sensitivity to interest rate changes is known as duration, and duration is measured in years. The higher the number, the greater the interest rate risk. Floating rate bonds have very low duration. An extreme interest rate risk example. About 5 years ago, the Austrian government issued a 100-year fixed rate bond, and this is when interest rates were low. At the time, the bond was highly sought after because the rates were attractive, but it became even more attractive when global interest rates neared zero. The graph shows the value of a €100 bond reaching €240 at its peak. Now, this would have been a fabulous return for investors, for first issue investors to sell at that point. But in more recent times, as interest rates have started to rise, the value of the bond has dropped and is now shown on the graph at €67. A significant loss for those who wanted to sell or want to sell, who had bought at first issue or even at the peak €240. Below the graph is a small table showing the bond price at different yields. The yield in the middle, 2.264%, is the current market yield. If interest rates go up, the bond price goes down, but if the yield decline, the price rises. Small 25 basis point changes at a 1% coupon rate can mean a loss or a gain of €6 to the bond price. Yield and spread. When investing in fixed income, you'll be quoted different terms. Now, yield is the overall expected return, while spread is the margin above a benchmark, often the 3-month bank bill swap rate. There are different terms for yield as well, Yield to maturity, YM, is the most common term and is all-inclusive. If you hold the bond to maturity, this is the yield that you can expect. Running yield, or RY, is the next 12 months' income. And yield to call is the yield to the next call date. Spread is the margin over a benchmark, and this is how most professional investors talk about return. It's the preferred way to compare bonds and takes credit risk, position in the capital structure, and investor protections into account. Yield versus spread and the capital structure. In this graphic, I've pulled out 3 fixed income levels in the capital structure: senior unsecured bonds, subordinated debt or bonds, and hybrids. As a reminder, as you move down the capital structure, you're taking on more risk, so you expect to be paid more. Now, the first column in the graphic shows example spreads and trading margin ranges for the securities, while the last column shows yield ranges. Trading margins are an effective way to compare corporate bonds and other fixed income securities. Credit ratings matter. Credit ratings help bond investors understand the perceived risk between different debt securities. This table shows the credit rating scales for Moody's, Standard & Poor's and Fitch. The S&P scale is commonly used in Australia. Now, investment-grade securities are very low risk with a very low probability of default and are shown in the chart as BBB- and above, so anything above the red dotted line. Now, I'm going to run through the different levels. AAA is the highest credit quality with minimal credit risk. The Australian Commonwealth Government is rated AAA. In the AA band, you have very high credit quality with very low credit risk. Moving down to single A, there's a high credit quality. It's considered an upper medium grade. And in the BBB band, it's good credit quality, currently low credit risk. Once the ratings drop below investment grade, the chance of default increases exponentially. In the BB band, there are speculative elements. The issuer faces uncertainties and adverse conditions. Moving down to the single B band, there's a high credit risk, but the issuer is able to meet its obligations. CCC, the issuer is currently vulnerable and default is likely. CC, the issuer currently is extremely vulnerable and nearing default. And R, SD or D is the lowest rating. The issuer is in default on some or all of its obligations. Issuers pay to have bonds rated. Typically, the lower the credit rating, the lower the cost to issue debt. Credit ratings for the same company differ across the capital structure. Asset-backed securities. Lenders need to raise funds to keep lending, and one of the ways they do this is by pooling assets such as residential property loans, commercial property loans, car loans and credit cards, and securitising them. A securitised pool of mortgages, for example, is put into a structure that has levels just like the capital structure. Those sitting highest in the structure are the lowest risk and repaid first. Repayment moves down the structure much the same way as a bank would in liquidation. Credit rating agencies play a significant part in this market as they assess the asset pools and rate each pool. They also determine the levels of subordinated assets needed to achieve certain credit ratings. The agencies also report on pool performance. There is a very strong asset-backed security market in Australia. In past stress markets, the Commonwealth Government has stepped in to support residential mortgage-backed securities, known as RMBS, to support our financial system. Here is a sample RMBS, the National Trust 2024-1 details. There are 7 tranches from the AAA rated A1 tranche down to the non-rated F tranche. Note how the credit ratings decline as the levels progress. By far the largest tranche is the A1 with $1,840 million issued. It has a weighted average life of 3.1 years, that is the expected term to maturity, and 8% credit support, which is the value of the other tranches combined, sitting below the A1 tranche. That is, 8% of the total pool would need to be lost before the A1 tranche would be impacted. Finally, the last column shows the margin over credit spread over 1 month bank bill swap rate. The A1 tranche margin is 95 basis points. The margin increases as we move down through the structure. See how it jumps from 220 basis points for the D tranche, which is still investment grade, to 465 basis points, more than double for the sub-investment grade E tranche. The lowest tranche, in this case the F tranche, is known as the equity tranche, taking first loss position. By comparison, here is an ABS for Angle Asset Finance car receivables. There are 8 tranches from the AAA rated A tranche down to the non-rated G2 tranche. The A tranche has a weighted average life of 1.7 years, but a much higher 25.5% credit support compared to the previous RMBS. So 25.5% of the pool needs to be lost before the A tranche investors would lose money. Car loans are short, so the weighted average life is also short. The longest expected term is 3 years. Note the margins are relatively higher with the A tranche 130 basis points and the sub-investment grade F tranche 610 basis points. There are 3 ways to buy fixed income securities. First, through exchange-traded funds or managed funds, and I think these are best for retail and passive investors. You don't have to make any decisions. The manager's making decisions when to buy and sell. But you don't have a maturity date, and this is one of the major benefits of investing in bonds. At a certain point, the maturity date, you get your capital returned to you. You also have no control over security selection. So if your existing share portfolio is weighted to financials, for example, you might not necessarily want a fund that is also weighted towards financials. Second, on the ASX. The ASX has a smattering of government bonds, hybrids and other debt securities, but it's really very limited. And if you're an investor here, you don't have any oversight over the broader market. And in fact, because demand is high, particularly for hybrids, prices are often inflated. And third, using a bond broker or dealer such as Income Asset Management. And I think this is best for those that want control over their investments, when to buy and sell, which securities to invest in, and risk and return. Now, you often need to be a wholesale investor, and there are minimum amounts needed to invest, but it is fairly easy to trade with a T plus 2-day settlement. So let's look at some of the key benefits for investing direct. First, diversification. You get to invest in companies that aren't listed on the ASX and in other currencies such as US or Euro. You can avoid sectors where you already have a large exposure, such as financials. And there's such a broad range of risk and returns available that will suit any individual investor. And you can access high-yield investments with equity-like returns. Second, income. You can construct your portfolio to deliver income when you need it. If that's monthly, you can set that up by choosing certain securities. You also get to choose your level of risk and return. And third, capital preservation. You can consider adding Australian or US government bonds, which also adds an element of diversification, or you can prefer investment grade securities. Another advantage of investing direct is that you can build your own guidelines. Some of the things you might like to consider are the levels of risk you're willing to take, the mix of investment grade and high yield bonds. Now, there's a really wide spectrum of risk and return, and you can try and define your maximum high yield allocation. Can you withstand volatility, and can you tolerate losses? Second, liquidity. Commonwealth government bonds are typically highly liquid, as are senior major bank bonds. Higher risk bonds are generally illiquid or severely discounted in a stress market. Consider maturity dates. Shorter term bonds have greater certainty than longer dated ones. Third, the split between different types of securities: fixed, floating, inflation linked. Also sectors like government, corporate, currency, geographical and sector. You can decide the amount you plan to invest, and this can change over time, and the minimum return requirement. Here's some sample portfolio guidelines. First, if you're looking for a defensive portfolio, you might have 50% to fixed rate bonds, 15% to inflation-linked bonds, and you would include an allocation to government bonds. Second, a portfolio to fight inflation: 50% floating rate bonds, 25% inflation-linked bonds, and 25% to residential mortgage-backed securities. Now, a balanced portfolio is just 50-50 fixed and floating. And lastly, a low interest rate risk portfolio. You don't want to take interest rate risk: 75% to floating rate securities and 25% to fixed rate securities, but with less than 3 years to maturity. Now, as we come to the end of this webinar, I want to talk to you a little bit about income asset management. Why choose them? To start, you would get a dedicated relationship manager who would provide a very high level of service. You would also access their team of analysts who provide industry recommendations and credit strategy. Income Asset Management is an ASX-listed group offering a complete income investment service. They have over 14 years of specialised industry experience and more than $3 billion in funds under administration. They have more than 25 staff in the capital markets team and offices in Sydney, Melbourne, Brisbane and Perth. They also partner with Netwealth, Hub24, Praemium, PowerWrap, Macquarie Wrap, and that underscores their commitment to making corporate bonds more accessible. Here are Income Asset Management's contact details. Get in touch with them today. Remember, if there's some concepts you haven't quite understood, either in this webinar or the first one, you can go back and re-watch them. Thank you so much for joining.